January 3rd, 2026, 2:01 a.m. American helicopters descended on Caracas. 30 minutes later, Nicolas Maduro was in custody, and $17.3 trillion in oil reserves changed hands overnight. But this wasn't about Venezuela. This was about something far more calculated, far more dangerous. 3 empires before this one, Rome, the Dutch, the British, all followed the exact same pattern. 7 stages, 7 predictable steps. And America just entered stage 4, the same stage that destroyed the Roman Denarius in 265 AD, collapsed the Dutch guilder in 1784, and dethroned the British pound by 1967. What happens in the next 18 months will determine which side of history's greatest wealth transfer you'll be standing on. And the clock is already ticking. Welcome to Currency Analyzer, where we examine the financial patterns most people discover far too late. If you've spent decades building something worth protecting, if you understand that wisdom comes from watching, not guessing, then subscribe to this channel. We genuinely value knowing from which part of the world are you watching this analysis right now? From which part of the world are you watching this analysis right now? Drop your location in the comments below. Let's begin. The operation began at precisely 2:01 a.m. on January 3rd, 2026. American military helicopters crossed into Venezuelan airspace under complete darkness. No warning had been issued. No diplomatic channels had been engaged. The mission was surgical, calculated, and devastatingly swift. 30 minutes later, President Nicolas Maduro was in United States custody. And with him, control of 303 billion barrels of proven oil reserves. At current market prices, that calculated to $17.3 trillion. To put that number in perspective, that's more than the entire GDP of China, more than Japan, Germany, and India combined. It was the single largest asset seizure in modern economic history. President Trump addressed the nation 6 hours later. His words were direct. We're going to have our very large United States oil companies go in, spend billions of dollars, fix the badly broken infrastructure, and start making money for the country. The global response was immediate. Financial markets opened in chaos. Oil futures spiked 11% within the first trading hour. Currency traders scrambled to assess what this meant for dollar stability. Gold jumped $140 per ounce in a single session. But something deeper was happening beneath the surface volatility. Economists who study empire cycles, the scholars who track long-term patterns across centuries, they weren't surprised. They had been watching for this exact move. Because throughout history, when empires reach a certain stage of fiscal stress, they always, without exception, do the same thing. They go after hard assets. The United States national debt stood at $38.5 trillion. Every single day, that number grew by $6.2 billion. Every hour, $255 million added to the debt. Every minute, $4.25 million. Every second, $71,840. Interest payments on that debt had just crossed $1 trillion annually for the first time in American history. That was triple what it had been just 6 years earlier in 2020. The Congressional Budget Office had run the projections. Under current law, the debt would reach 156% of GDP by 2055. Under alternative scenarios, if tax cuts became permanent, if spending continued its trajectory, the debt could hit 220% of GDP. Those numbers created an impossible situation. The Federal Reserve faced a choice with no good outcome: raise interest rates to fight inflation, and the debt becomes mathematically unpayable. Keep rates low to service the debt, and the currency loses purchasing power through inflation. This trap had a name. Economists called it fiscal dominance, the point where debt grows so massive that it controls all monetary policy decisions. And when empires enter fiscal dominance, when the debt becomes larger than the options to manage it, they start acquiring tangible assets, resources with intrinsic value, oil, gold, strategic minerals, anything that holds worth beyond paper promises. Venezuela represented the perfect target. The country held the largest proven oil reserves on the planet, larger than Saudi Arabia, larger than Canada, larger than Iraq. But decades of mismanagement had devastated the infrastructure. Production had collapsed from 3.5 million barrels per day in the 1990s to barely 700,000 barrels by 2025. The official narrative focused on restoring democracy, fighting narco-terrorism, humanitarian intervention. But the economic reality told a different story. $17.3 trillion in assets had just been secured, assets that could theoretically back dollar credibility, assets that represented real value in a system increasingly built on debt and monetary expansion. Yet experienced analysts recognized something troubling. Even if the United States invested the estimated $180 billion required to rebuild Venezuela's oil infrastructure, even if production returned to peak levels over the next 15 years, Venezuela would still produce less than 1% of global oil supply. This wasn't a solution to America's fiscal trajectory. This was a temporary measure, a band-aid on a systemic problem. And that realization led to a more disturbing question. If the United States felt compelled to conduct a military operation to seize 17.3 trillion in oil reserves, what did that reveal about the actual state of the financial system? Stable empires don't need to acquire resources through force. Secure currencies don't require hard asset backing through military intervention. The Venezuela attack wasn't the beginning of America's economic challenges. It was evidence of how far along the progression had already advanced. Because this exact pattern, this precise sequence of events, had played out before in history, 3 times, across 3 different empires, separated by centuries. And every single time, it followed 7 predictable stages. Stages that moved with mathematical precision from prosperity to expansion, to overextension, to resource seizure, to collapse. The question economists were now asking wasn't whether America was following the pattern. The question was, which stage had just been confirmed? There exists a pattern in human civilization that most people never see. Not because it's hidden, but because it unfolds across lifetimes, across generations. It moves so slowly that those living through it mistake each stage for permanent reality. But to those who study economic history across centuries, the pattern is unmistakable, and it's absolutely terrifying in its consistency. Historians call it the empire economic cycle. 7 distinct stages, 7 predictable transitions. And across 2,000 years of documented civilization, not a single empire has escaped it, not one. The cycle begins beautifully. Stage 1 establishes sound money, real value backing the currency, gold, silver, tangible assets that cannot be created from nothing. This attracts commerce naturally. Merchants trust the currency. Trade flows increase. Wealth accumulates through genuine productivity rather than financial manipulation. This is the foundation phase, the golden age, when empires are built on something solid. Rome experienced this, the Dutch experienced this, the British experienced this, and America experienced this from 1944 to 1965. But prosperity creates demand for expansion. Stage 2 arrives with social programs, infrastructure projects, public works, education systems, healthcare coverage. Initially, these are funded by the wealth created in Stage 1. The society feels genuinely prosperous. The middle class expands. Quality of life improves across all economic levels. But something subtle begins shifting. The empire starts spending more on maintaining prosperity than on creating it. Consumption slowly outpaces production. Most citizens don't notice. The decline is gradual, measured in decades, not years. Then Stage 3 introduces military overextension. To maintain global position, the empire must project power, protecting trade routes, maintaining overseas bases, defending allies, engaging in conflicts that drain resources faster than tax revenue can replenish them. The costs accelerate beyond what the economy can sustain. And here, the empire faces a critical decision. Cut spending and face internal collapse, or debase the currency and buy time. Every empire chooses debasement. In 64 AD, the Roman Denarius contained 94% pure silver. Emperor Nero needed funds for expansion. So the silver content dropped, gradually at first. By 100 AD, 85%. By 200 AD, 50%. Most Romans barely noticed the decline. But by 265 AD, the denarius contained only 0.5% silver, essentially worthless metal with a government stamp. Prices exploded. A loaf of bread that cost 1 denarius in 200 AD cost 10 denarii by 270 AD. 1,000% inflation across the empire. Soldiers demanded higher wages because their pay bought almost nothing. Emperor Caracas raised military salaries 50% just to maintain loyalty. It wasn't enough. Trade networks dissolved. Economic activity collapsed. Those holding land and gold survived the transition. Those holding denarii were financially destroyed. By 476 AD, the Western Roman Empire ceased to exist. 13 centuries later, the exact pattern repeated. Amsterdam, 1650. The Dutch Golden Age was in full magnificence. The Dutch guilder had become the world's first modern reserve currency. The Dutch East India Company was worth 7.9 trillion in today's currency, the most valuable corporation in human history. Amsterdam invented the modern stock market. They created sophisticated banking systems, international credit instruments. The world's commerce flowed through their canals. This was Stage 1 perfection. But maintaining a global empire required constant expenditure, colonial possessions across 4 continents, naval fleets protecting trade routes. By the 1700s, the Dutch were overextended, heavily indebted. Internal fighting erupted between provinces. Classic Stage 3 indicators. Then 1780 arrived, the Fourth Anglo-Dutch War. The British Empire, a rising power, challenged Dutch dominance directly. They attacked shipping, strangled trade routes. France seized the opportunity to strike simultaneously. The war lasted until 1784. The British won decisively. That war bankrupted the Dutch treasury. Their debt became mathematically unpayable. Their equity markets collapsed. And the guilder, once the global reserve currency, lost its status permanently. Wealth transferred from Dutch holders to British holders, from the declining empire to the rising one. The pattern had repeated with perfect precision. But the most instructive example came from Britain itself, London, 1900. The British Empire controlled 25% of Earth's landmass. The sun literally never set on British territory. The pound sterling dominated global finance for over 200 years. Britain presided over the Industrial Revolution, the greatest technological leap in human history. Steam power, railways, telegraph systems, manufacturing that transformed civilization. Surely technology would break the pattern. It didn't. By 1900, the costs of maintaining the vast empire exceeded the benefits. Britain started borrowing excessively. Other nations grew stronger. Germany industrialized rapidly. Japan emerged as military power. The United States expanded economically. World War I arrived in 1914. Financially devastating. Britain borrowed heavily from the United States just to fund the war effort. By 1918, Britain had become a debtor nation for the first time in centuries. They tried desperately to maintain the pound's value. They manipulated markets. They leveraged colonial influence. But by 1931, Britain was forced to abandon the gold standard. The pound was devalued. World War II drained even more resources. By 1944, at the Bretton Woods Conference, the truth became undeniable. The United States dollar, backed by 2/3 of the world's gold reserves, became the new global reserve currency. But Britain didn't surrender easily. Commonwealth countries held sterling balances for political reasons, not economic ones. The transition took over 20 years. By 1967, another major devaluation occurred. The pound lost 14% of its value overnight. Those who held pound-denominated assets watched their wealth evaporate. Those who had diversified into dollars and hard assets preserved purchasing power. 3 empires, separated by centuries, different technologies, different enemies, different political systems, yet the same 7 stages, the same fiscal mathematics, the same inevitable collapse, and now the same pattern was unfolding again, in real time, with the United States. The Venezuela operation wasn't random, it wasn't unprecedented. It was stage 4 behavior, textbook empire economics. And history had already written what comes next. August 15th, 1971, 9 p.m., Eastern Time. Most Americans were settling in for the evening. Television sets glowed across the nation. Families gathered in living rooms. It was a Sunday night, ordinary, unremarkable. Then President Richard Nixon appeared on every channel. His announcement lasted 17 minutes. Most people who watched it had no idea what they were witnessing. They heard words about international speculators, temporary measures, protecting American workers. But historians would later recognize that moment differently. That was the night America entered stage 3, the night the empire chose debasement over discipline, the night the pattern locked into place. Nixon spoke calmly. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold. Temporarily? That word mattered. It suggested a brief pause, a minor adjustment, something that would be reversed once conditions improved. 55 years later, the gold window remained closed, because what Nixon didn't say, what he couldn't say, was that America had already followed the exact pathway as Rome in 265 AD, as the Dutch in 1780, as the British in 1931. The pattern doesn't announce itself, it unfolds quietly, stage by stage, and it had begun decades earlier, July 1944, Bretton Woods, New Hampshire. Representatives from 44 nations gathered at the Mount Washington Hotel. World War II was still raging, but these delegates were designing the post-war financial architecture. They created something unprecedented. The dollar was pegged to gold at $35 per ounce. All other currencies were pegged to the dollar, and America held 2/3 of the world's gold reserves. This was stage 1 perfection. Sound money, real value, tangible backing. The foundation of American economic dominance was completely legitimate. Trade flowed through dollar-denominated channels. American manufacturing dominated global markets. Technological innovation accelerated. The middle class exploded in size and prosperity. This wasn't propaganda. This was genuine wealth creation. Productivity-based prosperity, stage 1 complete. Then came the expansion. 1945 to 1965. Post-war America built a welfare architecture unprecedented in human history. Social Security expanded dramatically. Medicare was created in 1965. Medicaid followed immediately after. The interstate highway system connected the nation. Public education expanded into every community. Initially, these programs were funded by real economic growth, manufacturing dominance, trade surpluses, technological breakthroughs. Quality of life improved across all income levels. The American dream became achievable reality for millions. This was stage 2 playing out exactly as the pattern predicted. Real expansion funded by real wealth creation. But the costs were growing faster than anyone publicly acknowledged. 1965 brought a critical shift. The Vietnam War escalated. The Cold War arms race intensified. Military bases appeared in over 80 countries worldwide. Each base required funding. Each soldier required payment. Each weapon system required development. The costs became astronomical, and other nations began noticing. France, under Charles de Gaulle, started exchanging dollars for gold. They saw the overextension clearly. They understood the mathematics. If America was spending more than it produced, if military commitments exceeded economic capacity, then the gold backing couldn't hold. De Gaulle wasn't being hostile. He was being rational. By 1971, the crisis had arrived. Foreign governments held more dollars than America had gold to back them. The system was mathematically unsustainable. Nixon had three options: cut military spending dramatically, cut social programs dramatically, or close the gold window. He chose the third option. Every empire chooses the third option. The dollar became pure fiat currency, backed by nothing except faith in the United States government. This was the debasement moment, the modern equivalent of Rome shaving silver from coins, and the consequences arrived immediately. The 1970s delivered double-digit inflation. Gas lines stretched for blocks. Prices doubled, then doubled again. The dollar's purchasing power was cut in half within a single decade. The empire was entering the danger zone, but something unexpected happened in 1974. Henry Kissinger negotiated an agreement with Saudi Arabia. Oil would be priced exclusively in dollars globally. In exchange, the United States would provide military protection to the kingdom. This created artificial demand for dollars. Every country needed oil. Therefore, every country needed dollars. Therefore, every country held dollar reserves. This was the petrodollar system. And it extended stage 3 by 50 years. But it didn't eliminate the pattern. It merely delayed the inevitable. Because the fundamental problem remained unsolved. Spending continued exceeding revenue. And the gap widened every decade. By 2000, cracks were appearing. By 2003, the empire moved into stage 4. Iraq, March 2003. The official reason was weapons of mass destruction. Intelligence suggested Saddam Hussein possessed chemical and biological weapons. Nuclear program development, imminent threat to regional stability. The invasion proceeded rapidly. American forces reached Baghdad within weeks. But no weapons of mass destruction were ever found. What was found, what was secured, was control of Iraq's oil reserves, the third largest proven reserves on the planet at that time. The official narrative shifted to spreading democracy, removing a dictator, liberating the Iraqi people. But economists studying empire cycles recognized something else entirely. Stage 4, behavior, resource acquisition through military means. Libya followed in 2011. The official reason was humanitarian intervention. Muammar Gaddafi was threatening civilians in Benghazi. A no-fly zone was established to protect innocent lives. But after Gaddafi's regime fell, what was secured wasn't just freedom for Libyan citizens. It was control of Libya's oil reserves and access to Gaddafi's substantial gold holdings, estimated at over 100 tons. Syria came next in 2011. The official reason was fighting terrorism. ISIS had emerged as a regional threat. American forces were protecting innocent populations from extremist violence. But the strategic positioning gained, the influence over resource-rich territories, told a different story. And then January 3rd, 2026 arrived. Venezuela. The official reason was restoring democracy, removing a dictator, fighting narco-terrorism, humanitarian concerns for the Venezuelan people. But what was actually secured was 303 billion barrels of oil, worth $17.3 trillion. This wasn't coincidence. This wasn't 4 separate operations with 4 separate justifications. This was stage 4, textbook resource acquisition, classic empire economics when currency credibility erodes. But here's what made this moment so critical. Stage 4 doesn't stabilize the empire. It's a temporary patch on a systemic problem because the underlying issue, spending persistently exceeding productive capacity, hadn't been addressed at all. All stage 4 does is buy time, usually 5 to 15 years, sometimes less. And while the empire focused on external resource acquisition, internal problems were accelerating dramatically right now. In 2026, the signs were unmistakable. Stage 5 was emerging, and what came after Stage 5 had already been written in the ruins of every empire that came before. The pattern doesn't negotiate. The pattern simply unfolds. The exodus began quietly. No press conferences, no official announcements, just private jets departing from New York, Los Angeles, Miami, landing in Dubai, Singapore, Monaco, wealthy families relocating, not for vacation, permanently. In 2025 alone, 142,000 millionaires left their home countries and established residence elsewhere, the highest number ever recorded in human history. This wasn't normal migration, this was capital flight. And capital flight is the signature indicator of Stage 5. When Rome entered stage 5, wealthy landowners moved assets to distant provinces. When the Dutch guilder began failing, Amsterdam's merchant class diversified holdings to London. When the British pound started collapsing, wealthy Britons transferred wealth to American investments. The pattern was repeating again. Projections for 2026 estimated 165,000 millionaires would relocate, the largest voluntary transfer of private capital ever documented. Where were they going? The United Arab Emirates topped the list. Zero income tax, political stability, asset-friendly legal frameworks. Singapore followed closely. Switzerland remained a consistent destination. Monaco, Portugal, countries that offered what declining empires couldn't provide anymore. Financial security. These weren't uninformed people making emotional decisions. These were individuals with access to the best financial advisors money could buy. They were reading the same indicators that historians had been tracking, and they were positioning accordingly. But capital flight was only one symptom. The dollar's share of global foreign exchange reserves had been declining steadily. In the year 2000, the dollar represented 71% of all central bank reserves worldwide. By 2023, that number had dropped to 59%. That 12% decline represented trillions of dollars shifting away from dollar-denominated assets. Countries were actively diversifying, not abandoning the dollar completely, but reducing concentration risk. China and Russia had begun settling bilateral trade in yuan and rubles. The BRICS nations, Brazil, Russia, India, China, South Africa, were discussing alternative settlement systems that bypassed the dollar entirely. India was purchasing Russian oil in rupees. Saudi Arabia, the cornerstone of the petrodollar system since 1974, had begun accepting yuan for oil transactions with China. These weren't hostile acts. These were rational economic decisions by nations recognizing the same pattern that wealthy individuals were seeing. Confidence wasn't shattered yet, but it was visibly cracking. This was early stage 5, the transition phase, where trust erodes but hasn't completely collapsed. And beneath that surface, stage 6 was already forming, the fiscal trap. United States national debt stood at $38.5 trillion, growing by $6.2 billion every single day. That's $255 million per hour, $425 million per minute, $71,840 every second. Interest payments on that debt had crossed $1 trillion annually for the first time in American history. $1 trillion just to service the interest, not to reduce the principal, not to pay down the debt, just to keep the system functioning. That was triple what interest payments had been in 2020, just 6 years earlier. The Congressional Budget Office had run multiple scenarios. Under current law, with no major policy changes, debt would reach 156% of GDP by 2055. Under alternative scenarios, if tax cuts became permanent, if spending continued its current trajectory, debt could reach 220% of GDP. Those numbers created what economists call fiscal dominance, the point where debt becomes so massive that it controls all policy decisions. And on January 5th, 2026, former Federal Reserve Chair Janet Yellen issued a public warning that sent shockwaves through informed economic circles. The preconditions for fiscal dominance are clearly strengthening. That statement was carefully worded, measured, but the implications were devastating. The Federal Reserve faced an impossible choice: raise interest rates to fight inflation, and the debt becomes mathematically unpayable. The government would default, not because it chose to, but because the numbers simply wouldn't work, or keep rates low to service the debt, and the currency loses purchasing power through inflation. Prices rise, savings evaporate, the middle class gets crushed. There was no third option, no clever policy that solved both problems simultaneously. This was fiscal dominance, the trap that every empire eventually enters. And at this point, people always ask the same question. But this time is different, isn't it? America has technology Rome never had: artificial intelligence, the internet, space exploration, quantum computing. American innovation will solve this. History provides a clear answer. The Roman Empire had revolutionary technology for its era, concrete that still stands 2,000 years later, aqueducts engineered with mathematical perfection, road systems connecting 3 continents, advanced metallurgy, sophisticated military equipment. Technology didn't save Rome. The British Empire presided over the Industrial Revolution, the greatest technological leap in human history. Steam power, railways, telegraph systems, global shipping networks, manufacturing capacity that transformed civilization. Technology didn't save the British pound because the problem was never about productivity. The problem has always been about one fundamental relationship: spending versus revenue. And when spending persistently exceeds revenue by massive margins, 6 to 7% of GDP annually, no amount of technological innovation solves that equation. The United States would need sustained 5 to 6% GDP growth for decades. That hasn't happened. That won't happen. Then comes the second argument: The dollar is the reserve currency. Other countries need it. It's too big to fail. Reality check. The British pound was the reserve currency for 200 years. It failed anyway. Reserve currency status doesn't prevent decline. It delays it. And it makes the eventual fall more devastating. Because when reserve currencies collapse, they take entire global financial systems with them, temporarily. The third argument. America can just print money, will never default. Technically correct. The United States can print unlimited dollars, but printing money to pay debts is hyperinflation. That's not saving the system. That's destroying it differently. Zimbabwe tried printing money. Their currency became worthless. Venezuela tried printing money. Their currency collapsed. Weimar Germany tried printing money. Citizens used banknotes as wallpaper because it was cheaper than buying actual wallpaper. Printing money doesn't create wealth. It transfers wealth from holders of the currency to those who print it first. This time isn't different. The pattern is absolute. So what does history tell us about survival strategies? Every empire collapsed in recorded history rewarded the same asset classes: gold, silver, productive land, strategic resources. When Rome collapsed, those holding agricultural land survived. When the Dutch guilder failed, those holding gold and silver preserved wealth. When the British pound devalued, those who had diversified into dollars and hard assets maintained purchasing power. The pattern is unmistakable. But there's another critical factor: specialized skills. Healthcare professionals, engineers, agricultural experts, skilled tradespeople. If someone can provide essential services, they maintain earning capacity regardless of which currency is collapsing. During Argentina's multiple currency crises, those with in-demand skills adapted. Those dependent on fixed income or cash savings were financially destroyed. Geographic diversification matters too. Those 142,000 millionaires relocating this year understand something crucial. When empires enter late-stage decline, capital controls often follow. Wealth taxation, exit taxes, asset confiscation. Having optionality, second residences, foreign accounts, international business structures provides protection. This isn't about being unpatriotic. This is about recognizing historical patterns and acting rationally. The timeline is projectable based on historical precedent. Next 2 to 5 years, increasing wealth migration, rising inflation, currency volatility, growing social tensions. Next 5 to 10 years, potential loss of reserve currency status or significant erosion of dollar dominance, increased capital controls, possible sovereign debt crisis. Next 10 to 25 years, major monetary reset, either hyperinflation or default. Complete restructuring of the global financial system. This isn't speculation. This is pattern recognition. The Venezuela raid on January 3rd, 2026 wasn't the cause of the wealth transfer. It was a symptom. Evidence of where America stands in the cycle. Stage 4 confirmed. Stage 5 emerging. Stage 6 beginning to manifest. The pattern has been absolute for 2,000 years. Rome thought it was different. The Dutch thought it was different. The British thought it was different. The pattern didn't care. And right now, the pattern is unfolding again. The wealth transfer is coming. The only question is which side someone will be on. The side that preserved wealth or the side that lost everything. The window to position is still open, but it's closing. Day by day, hour by hour. $6.2 billion of new debt every 24 hours. The pattern doesn't wait. The pattern doesn't negotiate. The pattern simply unfolds.